Ladies and gentlemen, thank you for gathering today as we reflect on the current state of the U.S. stock market, its recent highs, its sharp pivots, and the deeper lessons for investors, companies, and economies alike. We begin with the broad picture. Over recent weeks, the major indexes, the S&P 500, Nasdaq Composite, and Dow Jones Industrial Average, have been on a roller coaster. On one hand, markets rallied, hopes for records returned, and for many sectors, the expansion of artificial intelligence, cloud infrastructure, and digital transformation seemed unstoppable. Yet on the other hand, recent data show a sharp pullback, particularly in technology stocks, with the tech sector enduring its worst week since the tariff-driven sell-off in April, losses that signal investor caution. Market Watch. Why is this moment meaningful? Because it reveals three core dynamics at work: enthusiasm, reality check, and transition. First, the enthusiasm. For much of 2025, technology and innovation, especially AI, were the engines of market optimism. Investors believed that companies making big bets on AI, data centers, cloud infrastructure would reap outsized returns. Indeed, many tech stocks soared as part of the broader narrative of digital disruption. The rally wasn't just about growth, it represented a belief that the old paradigms of business were being reshaped. In that environment, markets often pushed valuations higher, in part because the story was so compelling, and in part because alternatives, traditional industries, seemed less exciting. Second, the reality check. Here is where caution enters. Recently, tech stocks suffered sharp declines. The technology-heavy indexes pulled back. Some major firms dropped 4 to 11% in a week. For example, high-growth AI companies saw meaningful losses despite solid forward narratives. Financial Times. The narrative remains powerful, but valuations appear stretched and investor patience seems being tested. One article put it this way: is Wall Street losing faith in AI? The implication being that the market is beginning to ask, when will the returns justify the hype? TechCrunch. The key takeaway here: when a sector has been the primary driver of market gains, a pullback there can ripple across the whole market. Investors who are concentrated in tech now face the experience of volatility, reminding us that high growth often comes with high sensitivity. Third, the transition. What we are witnessing may not be a crash, it may instead be a transition. Markets shifting from full-throttle growth to a more measured phase in which execution, cost discipline, and realistic timelines matter. It means investors, companies, and economies must adapt, from growth at any cost to growth with sustainability. From promise of tomorrow to delivery of results. From outsized valuations to more balanced return expectations. The market's recent behavior suggests that the pendulum is swinging from exuberance to evaluation. What does this mean for different actors? For investors, diversification remains essential. When one sector carries the bulk of growth expectations, as tech has done, you face concentration risk. It is wise to ask, what happens if growth slows? What happens if valuations compress? The current environment invites questions about portfolio resilience, drawdown risk, and time horizon. The pullback in tech is a reminder: markets move in both directions. For companies, especially in technology and growth sectors, the narrative matters, but so do execution, margins, cash flows, and clarity of roadmap. If you're counted on to deliver tomorrow's revenue today, the market will penalize missing. And when valuations were rich, the market may have given you the benefit of the doubt. Less so now. The pressure to deliver becomes greater when the cost of investor optimism rises. For policymakers and economists, the market serves as a feedback mechanism, not just for profits, but for risk, leverage, sentiment, and economic expectations. When valuations run high and investor confidence wavers, the facts of inflation, interest rates, global trade, regulation start to come more sharply into play. Markets remind us that expectation, policy, and execution are intertwined. For the broader economy and society, let us not forget that markets are not an abstract game. They reflect real investment, employment, innovation, and future capacity. A shift in investor sentiment can slow hiring, expansion, capital expenditure. At the same time, a pullback in tech does not mean the end of growth. It may simply signal a pause, recalibration, or reallocation of where growth will come from. In conclusion, the U.S. stock market today sits at a crossroads of excitement and introspection. The promise of innovation remains vast. But the market is reminding us, promise alone is not enough. Growth must translate into value. Hype must translate into discipline. Momentum must translate into sustainability. The test ahead will not simply be, can tech stocks keep rising? The bigger question is, can the market deliver next phase growth across sectors, geography, and business models in a world where interest rates, inflation, regulation, and global competition matter more? We are moving from a phase of what might be to what must be. For you and me, whether as investors, professionals, students, or citizens, the invitation is this: stay informed, stay diversified, stay realistic, but don't lose sight of the opportunities. Because the next leg of growth may not look like the last one. It may be quieter, more selective, but it will matter deeply. Thank you. Market Watch Financial Times Tech Crunch.